Hello everyone, welcome. Today, we're looking at the difference between final goods and intermediate goods. This distinction is crucial in national income accounting because it helps us understand what is included in GDP and what is not. Here's the golden rule of national income accounting. A good is classified as final or intermediate based on how it is used, not on what it is. The intended use of a good determines whether it is included in GDP. Final goods are goods meant for final use by consumers, businesses, or the government. They are not used for further production and are included in GDP. For example, bread bought by a household, a refrigerator for home use, machinery bought by a factory, or a house sold to a buyer. Their market value already includes the value of all inputs used in production. Intermediate goods are goods used as inputs in producing other goods or services within the same accounting period. They are not included in GDP to avoid double counting. Examples include flour used by a bakery, milk used by a sweet shop, steel used to make machines, or petrol used in factory operations. The same good can be final or intermediate depending entirely on its use. This slide shows why context matters. Milk bought by a household is a final good, but the same milk used by a sweet shop becomes an intermediate good. Similarly, a computer used in an office is a final good, but one bought for resale is intermediate. So, classification depends on use, not the physical nature of the good. Simply adding the value of wheat, flour, and bread is the wrong method. Doing this leads to double or even triple counting. In this example, adding 50 cents for wheat, 150 for flour, and 350 for bread gives 550, which is incorrect. This inflates GDP by counting the same value multiple times. There are two correct ways to measure GDP here. First, the final goods approach, where we count only the value of the final product, the bread worth 350. Second, the value added approach, where we add the value created at each stage. Both methods give the same correct GDP contribution of 350. To wrap up, remember three things. First, classification depends on use, not the nature of the good. Second, excluding intermediate goods prevents double counting in GDP. And finally, capital goods are treated as final goods because they represent investment. Thank you for watching and staying through this session. To help you revise and practice further, the links to a short quiz, extra practice questions, and a summary infographic are provided in the description. Make sure you check them out. They'll help strengthen your understanding and improve exam confidence. See you in the next lesson.